The one thing we're going to teach you today is how you can actually get to your goal of retirement, or whatever you said your retirement wishes are, without giving up control of your money, without not having that money to use when you need it, to take advantage of opportunities. We're going to teach you how to dream bigger, be in more control, and do it with the real 4% rule, not the nonsense and bullshit that I learned as an advisor of called the 4% withdrawal rule, which is the 4% to failure rule, if you ask me. Devin, tell me a little bit about your retirement. And actually, hold on, let me rephrase that. Tell me a little bit more about how you viewed retirement just a short year and a half ago, and how you're looking at it today, because you've got something really special prepared that you've been having the mapping team work on with you. And you know, I've heard rumors of this thing, and I gotta tell you, that sounds too good to be true, but I hope you're ready to show that today.
Retirement to me, I mean, I'm only 36, so truth be told, I really wasn't thinking about retirement. It was just so far in the future to me. And looking at my mom, looking at my dad, they still work and they're in their mid 60s. So in my mind, I was thinking, well, I'm probably still going to have to be in that same situation. And you always hear like the golden years, right? Most people, when they retire, the years aren't golden. Like if you think about like a 401k, you're putting money into it, and the hope is that you don't have as much expenses, so your lifestyle is lower, so you're not going to get taxed as much. In the golden years, shouldn't your lifestyle be better, not worse, right? I never really thought of retirement because it was kind of just scary. I didn't know where it was going to be, how I was going to get there. I knew a 401k wasn't going to do it. And yeah, ever since last year, ever since then, starting to use policies, funding real estate deals with it, seeing how you can actually just move money and grow money. And then having the idea of, hey, let's use one of these policies as a retirement vehicle. Let's see how powerful it can be. And yeah, the teams have been working on it, and it's incredible. So excited to share it with all you guys.
But you were also told some, I don't want to call them lies, but some myths, if we will, about retirement, about the best way for you to get to retirement. Are we going to hit any of that, or is that going to be saved for another episode?
That's up to you. We can go down any rabbit hole you like.
So what we're going to show you now is what so many of you already know about and keep commenting on, which is obviously the most popular thing. And next week's wealth webinar is all about this. So make sure you join us next week. You guys will love it. But we're going to go into Devin's retirement strategy, but we're doing Devin's retirement using privatized banking, or some of you might know of it as the infinite banking concept. So I want to kind of, a lot of people get confused when I say privatized banking and the infinite banking concept. They think they're two different things, which they really are, but they're used for the same thing. The private bank is the specially designed and engineered whole life. It's the machine we use to move your money. The infinite banking concept is the process. It's the banking process. It's how we actually move the money to actually make you more money. Those two components, the private bank and the infinite banking concept, are what we teach, and it's what we're going to be teaching a lot about next week and on the next couple episodes of the Wealth Webinar. But Devin has literally taken this concept and created ways to use the infinite banking concept and his banking system for many things that we never even thought possible. And what we're going to show you here, and I've done this before, but we're going to show you how Devin is using his private banking policies to provide a retirement. But even better, he's not going to just park the money in this policy and wait till retirement. He's going to use that money every second of every single day up until retirement. So Devin, why don't you take it from there and let me know if you need me to draw anything or do anything along the way.
I appreciate it. Yeah. So for those of you that don't really know who I am, I found out about this last year during the pandemic. Was listening to a podcast, heard Chris on it, and I just went down the rabbit holes. I wanted to learn everything I could about this. I was investing in real estate, and I thought this could be a great way for me to kind of turbocharge that business. So I got my first policy. I was super reluctant. Chris can attest to that. But got my first policy. I started using it right away. And as soon as I saw that it was real, I had so many people in my ear saying, that's not how it works. You can't do that. The money's going to be trapped for 10 years before you can touch it. I was able to get the money back out a day later once I put the money in. So once I saw that, I was like, let's go. We immediately, me and my wife, funded 2 larger policies. I'm going to show you guys these. These are combined. So the number is 275,000. That's 2 policies, one for me, one for her. And can I actually have the screen?
Yeah,
So they can see the policies?
You should have the ability to do that.
Here we go.
Yep.
Should be this one. All right, so you guys able to see that?
Not yet.
How about now?
Nope, just your pretty face.
Well, if I was as good at computers as I am at IBC, I'd be dangerous.
You want to email it over to me and I can put it up? Send it to my flip out email.
I thought that I had it up here. All right, cool. I'll send it over. But yeah, so guys, it's $275 a year is the policies combined. And anyone who does not understand how the policies work, you max them out during the first few years. Once you get to the MEC limit, you can't put in additional money into the policies. So you basically can only put in your premium, your base premium. So you'll see that on the screen. So as I was saying, guys, 275, this is the max amount we can put in for 10 years. This is between 2 policies, one for me, one for my wife. After 10 years, we're unable to overfund it that much. We can only put in the base premiums, which is 110. So 275 a year, we can all do easy math. That's 2.75 million after 10 years. I would be 46 years old, turning 46, so still a young man. We would have $3.1 million in cash value. Now, if you guys look right here, the difference between year 9 and year 10, it increases by $373,000, the cash value. So I could use all this money, which I do. I use these for investments and never pay this money back. And it's just going to keep growing year in, year out. So it grows by 373,000 in year 10. Year 11, all I can do is 110. That's the max that I can put into it. You should never stop putting into a policy because of the cash on cash return. When you have income, you should always keep putting into a policy. But just for an illustration, I can literally stop putting money in at year 11, not one more penny for the rest of my life. So this 110 each year will be covered by the cash value, because as you see, it went up 373,000. So the 110 can be covered out of that, plus the difference I can pull as retirement income, tax-free. And it'll, again, just continue to grow because of the uninterrupted compound interest. So the next year, same thing, grows by 234,000. So that growth can pay for this next year's premium of 110 and also leave me with about 120 grand tax-free retirement income. It literally just keeps happening. And this is all the way until I'm 100 years old. Hopefully I'm still living that long with advances in modern technology. I would imagine that I would, but bottom line is I literally at year 10 never have to put another penny into my policy, and I can pull about $120,000 a year tax-free retirement income, and the policy is actually paying the premiums every single year for me. So this is a basic illustration of it. As you can see as well, my death benefit keeps going up. So I would never pay back the policy loans that I'm taking. So let's say I pass away, me and my wife pass away this year. Projected cash value about 8.5 million. If we never paid any of that back, death benefit's still 27 million. So who's getting the difference? My daughter. She'll be set. And that's with us never paying back any policy loans. So you want to talk about a nice retirement. That's at 46 years old. I can retire with $120,000 of tax-free income, never put another penny into my policy, and just keep taking $120,000 a year until I'm 100 years old. So I don't know how it can get much better than that.
You better watch your back when
You
you
want to
fall
add,
asleep
Chris?
at night with your daughter there.
I know, right? Well, I've got a couple policies on her too, so she might have to sleep with one eye open. But yeah, anything to add to this, Chris?
No, not so
Have you
much.
even seen? Have you seen this yet, or?
I have not. No, this is what Andrew created, but didn't he also create like a retirement strategy for you as well? Or is that's not what
Yeah, it's in here. It's
'cause you have one that shows go to yeah, retirement. There you go. Yeah, this. In a nutshell, a lot of numbers here, but this is using his plans, and this is one of the plans we designed. It's called the High Early Cash Value Plan. And these are just showing him if he started taking doing a retirement plan and taking income from these, he can retire at the age of 45 and never look back. And I think how he did it is he showed loans being paid back at age 45. And then he said, over here, let's look at it if we never pay the loans back. Andrew gets pretty involved and pretty detailed with the numbers. We'll have to take this and summarize this so that it's a little easier on the eye, because that's just too many numbers for the average person to really kind of wrap their head around. But yeah,
here's where it's at though. The 120. So you can see this is the 120 of retirement income per year coming out until I'm 100 years old. So this would be the loans taken out of it. So you see 120, it's $120,000 loan. Year 2, 120, it's up to 240. So by the time I'm 100 years old, I've taken $6.7 million worth of policy loans as retirement income. But anyone that understands these policies, when you take a policy loan, that's not your money being removed from the policy. It's the insurance company's money. It's an advance of your future death benefit. So your money sits and continues to compound. That's why this is possible. So yeah, he mapped out if I paid back all the loans where I would be. So through year 10, if I paid back every loan that I take out, my net cash value is 2.7 million. If I don't, then my net cash value is negative. I wasn't understanding this part. So Chris, if you want to jump in and clarify on this, I wasn't understanding why it was negative at that point.
Why it was negative in the first year here?
Yeah.
That's because he showed no loans being paid back. So what he's showing, I think, right, Andrew, that the negative number in year 1 is that he's got a negative 164 net cash value.
Yeah, that's why, because you didn't pay any loans back.
So you didn't pay any loans back, but can it still be a negative? That doesn't make sense.
It was just in this 1 year. Yeah. So what we did is we started at 46. He retired at 45.
Oh, okay. That's why, Devin, because what he did here is if you were to retire at age 45 without ever paying loans back, you would have been short 164,000. So you have to retire at 46. Sorry, man. So if you never pay any of those loans back, if you're a terrible banker and you don't treat your money the same as you treat the bank's money, and you never pay any of those big loans you keep taking out for all these real estate deals, you're going to be short on that 40 target of 164. So you're going to have to wait a year and retire at 46. Hey, listen, Walmart's hiring, man. So you can just go get a part-time job for the 1 year, and then 46, it's all good, man.
Wait, stop. So I can't retire at 45?
Not if you don't pay the.
I don't want these policies anymore. I'm surrendering them. I don't want
Sorry,
them.
bro. I tried.
I don't want them. I don't want nothing to do with these things no more.
That's all right. We should run this scenario on that real fancy dancy IUL you own there and see when you can retire. I think that'll put your retirement somewhere around 92 years old. You'll probably die before you ever can retire with that thing.
I think I looked at it. No, you got to wait until 112.5 years.
Nice.
We're actually not really joking too much, folks. Like, we're actually not joking about that. We're actually going to be doing a whole training on his IUL.
Yeah. So a little background on that, guys. Again, learned about this in the pandemic, and I had a certain someone in my ear, financial advisor, saying that whole life is horrible. Like this guy, Chris Naugle, he gets all your money. He tells you can take policy loans right away. Verbatim, this was his words. There is no insurance company out there that'll give you a loan that quickly. So I was skeptical and I thought I trusted this guy. So I started 2 IUL policies with him, index universal life policies. Didn't know what I was doing. And it shows because they are not good policies. But to these ones, everyone works policies different. The way I do it, and this is not saying it's right, not saying it's wrong, this is just how I do it. I never focus on paying loans back because, in my opinion, if the money is moving, if it's growing, if it's in an investment, there's no need to pay it back. As long as I can make money with that money, why put it back in the policy? So I would probably be on this side. I wouldn't be paying my loans back. So if the money's moving, it's growing, I don't worry about putting it back into the policy.
Well, one thing that's missing from this equation on the no loans being paid back, like you said, what we're not accounting for here is by having all those loans out working for you, all that money is making money. I mean, some of the people watching this have seen your scenarios, but just so everybody knows, like, this is just his policies. Okay. And I think there's what, 3 policies in this?
There's 2.
Oh, this is just 2 policies. Sorry, I thought it was 3. So I just answered this back. Someone saying it was 3. It's actually 2. So this is just his 2 policies. This has nothing to do with how much money do you have out in loans at this point?
Cumulative loans are
Where are we
about
at?
2.7.
2.7. So he has, yeah, there we go, right in the middle. Got $2.7 million in loans out there. Devin, what would be the, if you really mess up, what would be the lowest amount you would earn on $2.7 million that you have out in loans? Like literally, like everything falls apart. And what would be the minimum amount you could earn on
that? Annually?
Yeah, like just a percentage. Like what rate of return do you earn on that 2.7 million that you have out in loans? Bare minimum.
So I would say probably about a 6% return.
So what if I just said you can only, you suck at what you do and you only make 3%? Is that fair? You think sleeping, you could probably make 3%? Folks, that means
sure.
that his $2.7 million, if it only made 3%, which never would happen on Devin's clock ever, but if that's all it made, that would be $81,000 on top of these numbers, which would mean he would probably be able to retire halfway through at 45 and a half because he's got $2.7 million making money. But see, if I know Devin, he's not going to make that. He's probably going to make more like 10 minimum, which means he's going to have $270,000 in income coming in just on the loans, plus the 120. I think that are you taking 120 out? Yeah, plus the 120 tax free. So he's got 270 of taxable income plus 110,000 or 120,000 in loans he's taking out tax free. That's his income, folks. So we're not showing the whole story here in his retirement because all we're showing you is just the policy doing what the policy does, which is boring. He's got another $2.7 million out there working, making something. And you saw the numbers, 3% is $1,000. And if he makes 10%, then that's like making 200 and some $1,000. So
dude, I'm actually glad. I'm glad you brought that up because I totally didn't even think about that. This first year of using these policies, we've purchased and we burr properties. So purchase them, renovate them, get them rented out, refinance them, and repeat the process. We've purchased 8 properties. Those 8 properties are pumping off cash flow of about $80,000 a year. So if I just do what I did this last year for the next 10 years, we can do the math. That's a lot of income that is retirement income on top of this 120. And the 120 is tax free. So that's really like getting what? 190, 200 grand.
Yeah.
So I'm glad you brought that up.
Somebody just asked you, how is it you're making more than 10%, and where are your investments making more than 10%? See, a lot of people, and that person that said that, they're probably thinking traditional investments, mutual funds, stocks, bonds. Yes, maybe the last couple of years you might have made 10% or more, but it's very volatile. We don't invest our money really so much in stocks. What Devin does is real estate, or he's the bank on real estate deals. So he'll lend to real estate investors. And I lend to real estate investors at a rate of 12%. The thing we like about real estate is you always have a tangible asset. And the reason we like real estate also is look at the wealthy, Blackstone, BlackRock. Where are they putting $120 trillion? None other than real estate, because you can always cash flow real estate. You can always make money on it. And even if a deal goes sour, someone doesn't pay you, you foreclose on that commercial loan you did, take it back, and then you do the deal, either rent it out But that's the thing. You're always secured by a tangible asset. That's the difference.
Yep. Yeah. You know how many mutual funds that I own, Chris?
Mm-hmm. Zero. But that
Zero.
case when I first met you, you were on mutual funds with our guru advisor out there in California, not using his name, but man, if I ever see him,
You got a few in your IULs too, man. You got a few in there.
yeah.
Whatever.
You got some mutual funds in those IULs, or at least exposure to indexes.
I don't even want to think about those things, but yeah, we had about 120 grand in the market with a good old buddy out there in Cali. And yeah, I told my wife, I'm like, we need to take that out immediately, because turning it over to someone else is basically saying, I think you can actually make more money with my money than I can make with my money. So it's like just saying that you don't think that you can make money on your own. And I know how money works now. I know how to make money. So giving it to someone else makes zero sense. So yeah, zero mutual funds unless it's inside of my IUL, which I wish I didn't have.
Yeah, and a lot of people are looking at the premium deposits you do into these policies, and they're like, wow, those are big policies. But can you just explain why? I mean, this isn't like some magic. It's not like, these are big plans. You know, how much? It's a couple $100,000 in each one of the two plans. But that couple $100,000, he had that because he's a real estate investor. And there's all real estate investors work in larger dollar amounts. It might not be their money, but it's larger dollars. So, can you just kind of give somebody just insight on that?
Yeah, for sure. I mean, at the end of the day, the numbers they're arbitrary. Like, you can do this with any amount of money. You could do it with 6,000 a year, 10,000, 20,000, and you're going to get the same benefit. Just the numbers aren't going to be as big. I have smaller policies. I've got 2 policies that are $6,000. We're starting another policy that's like a dump in of, I think it's $5,000 and then $700 a month. So what we try to do is we look at how much money we have coming in, me and my wife, how much money we have coming in opposed to how much goes out. Luckily, we don't spend frivolously. Our cars are paid off. We don't live in some crazy house, so our mortgage payment isn't super high, and we make a good amount of money. So we look at that and say, how much can we put into policies? We should be putting as much as humanly possible into them, because we have full control of the money. It's liquid, and you guys can see the numbers. They don't lie. So at the end of the day, you should try to get as much as you can into a policy. If you can't get as much as I can get into a policy, that's one thing, but there's people that can get much more into policies than I can. So it's all relative at the end of the day. I firmly believe that whoever you are in whatever situation you're in, you should try to get as much as humanly possible into policies, period. If you guys ask any successful person, they will tell you that a major key to their success is who they surround themselves with. If you're constantly surrounding yourself with people that are out of shape, you're probably going to be out of shape, right? Because they're going to go get fast food. They're not going to go to the gym. If you constantly surround yourself with people that have a six-pack, they eat the right things, they do the right things as far as training, they go to sleep at the right time, you're going to probably do those same things. It's no different when it comes to money. If you're constantly surrounding yourself with people that make money and serve others, what are you going to do? You're going to be the same way. And if anything, you're just going to try to level up so that you're not the oddball out. So one of the best things I ever did for myself in my career was basically going to meetups, going to places where real estate investors are at, and just being a sponge, literally just asking questions, being super interested in other people that are successful, because success leaves clues. And if you just surround yourself with those people, bottom line is you're eventually going to be one of those successful people.
Absolutely. No, it's, you've heard it a million times and it's kind of cliche, but your network is your net worth. And, just for example, Randy Garn. So Randy Garn is flying out to this event. Now you guys should look him up, but he's my mentor and I pay him $5,000 every single month to mentor me. which gets me a 1-hour coaching call. Now, most of you would think that that's absolutely ludicrous, but that's just insane to pay somebody that much money for 1 hour a month. What you don't understand is Randy, who is the one that sold the company, a big company called Prosper for, I think, something like $800 million, and he's spun off several other companies. His network alone, the people he surrounds himself, the 6-packs he surrounds himself with, which might not be actual 6-packs, they are worth $600,000 or more to me. So the $60,000 I pay him gets me access to a network that just from the surface opens me up to do things like get on Bigger Pockets podcast. Not an easy thing to do. Opens me up to people like Brandon Steiner to come to my event, and the only thing I had to do is pay for his airfare and his hotel. This is the guy that bought the Yankee Stadium, folks. You think he just shows up at your house? This is literally the gateway to how you crack your code, how you crack the code to your success. It's not going to happen without you taking action. It's not going to happen with you sitting in California wondering whether or not you should or should not do something. It's going to happen by you taking action and getting shit done. That's how I've done it. It's how Devin did it. It's how Steven did it. It's how every one of them did it. There is no such thing as luck. And if you believe that luck exists, eventually that luck will run out unlucky. It's just how it works. I'm not trying to be mean. I'm not trying to be, actually, maybe I am, because maybe I don't give a shit, because sometimes the truth freaking hurts and people just need to hear it the way that it is. So love it, hate it. I don't have my haters need hugs shirt on today, but if I did, you'd understand. I get a lot of hate and I love it, because a hater is also it's one step away from being my next best ally. That's how the world works.